In this presentation, we will explore the topic of managing student loan debt, putting student debt in perspective, gathering data on federal loans, and planning in order to avoid student loan default. By the end of this lesson, you should be able to access the federal student aid website, gather and organize loan data by accessing the National Student Loan Data System, describe the loan default process, and understand the implications of student loan default. As you undoubtedly realize, the national level of student loan debt is quite high, and it's only expected to escalate. As you can see from this 2012 Inside Higher Education graphic, the median debt for a student's combined undergraduate and graduate education is close to $58,000. As you move into the 75th and 90th percentiles, the median jumps to $100,000 and $153,000 respectively. Did you know that it's not uncommon for physicians and dentists to have over $400,000 in student loan debt? The federal government is by far the largest provider of student loan dollars. The bar chart entitled New Student Loans from the College Board and Federal Reserve Board reveals that the federal government provided 93% of all student loans during the 2011-2012 academic year. Also notice that the line chart depicting the debt outstanding reveals that the accumulated amount of student loan debt now exceeds auto, credit card, and home equity loans. This mounting debt is of tremendous concern, and you as a financial planner will certainly have to deal with this when working with your clients. Of course, advanced degrees have positive economic value. The U.S. Census data on the slide from 26 through 2008 demonstrates the economic value of earning a bachelor's, master's, and doctoral degree, as compared to those individuals with only high school educations. The difference exceeds $1 million over a person's lifetime. There are other definite positives besides economic value. First, student debt is an investment in oneself, and I can't think of a better investment than that. The education and college experience may allow you to follow your dream or find your vocation and purpose. Furthermore, higher education is a social objective, and as such, Congress has provided some tax advantages, including above-the-line deductions on student loan interest, educational tax credits. Finally, those tax-advantaged fixed-rate loans are paid back over time with inflated dollars. Of course, the debt burden is a challenge. First, monthly debt payments detract from pursuing other goals, other priorities. Meaningful student loan debt adversely impacts one's credit rating, which in turn makes it more difficult to qualify for additional debt. In the second part of this topic lecture, we'll examine strategies for managing monthly loan repayments and ways of maintaining or rebuilding credit scores. Another area of challenge is psychological. The stress of making payments every month for years and years can build up and potentially impact well-being, particularly if the college experience and job-related outcomes didn't work out optimally. Having put student debt into perspective, let's investigate sources of loan data. The Federal Student Aid website is an incredible resource for gathering information about different types of loans, methods of repayment, details about consolidation, current interest rates. You can access the website at studentaid.ed.gov. For example, let's quickly review the types of federal loans by recapping information provided on this site. The Federal Family Education Loan Program, or FFEL, offered federally backed loans. With this program, non-governmental institutions issued the federal debt. The program was eliminated in March of 2011, and now federal loans are offered directly from the Department of Education. FFEL loans qualify for consolidation with direct lending, and they qualify for most of the same repayment plan options that are now available to direct loans. The U.S. Department of Education is a lender of direct Stafford loans. The student borrower is assigned a servicer. As you'll learn in Part 2, there are excellent consolidation and repayment opportunities. There are two categories of Stafford loan: subsidized and unsubsidized loans. The subsidized Stafford loan is awarded to undergraduate students with financial need. The Department of Education generally pays interest until 6 months after graduation or the end of half-time student status, and also during periods of deferment. The unsubsidized Stafford loan is awarded to both undergraduate and grad students. Financial need is not an issue. Note that interest accrues to the borrower on the disbursed amount during the grace period, 6 months, deferment, or forbearance periods. Perkins loans are low-interest loans awarded on exceptional financial need to full or part-time undergraduate, professional, and grad students. The Perkins Loan Program is a school-based program. The school is the lender, the federal government provides the funds. The Department of Education pays interest until 9 months after graduation or the half-time status ends. Note that the possibility of loan forgiveness is much higher with Perkins than other types of loans. Grad Plus loans are available to grad or professional degree students enrolled at least half-time in an eligible Title IV institution or certification program. Payment will be placed in a deferment until 6 months after half-time ends. However, interest accrues unless the student pays it during the deferment period. Parent Plus loans are available to parents of dependents, undergrad and grad students, and financial need is not an issue. The parent can borrow 100% of educational costs less loan amount to the student. The payments begin at the time the loan is taken out. An excellent source for gathering student loan data is the National Student Loan Data System. You can access this site by going to www.nslds.edu.gov. Once there, the client can access their personal information by using their PIN. After entering in the PIN, the client and planner can take an inventory of existing loans. The loan information will allow you to get organized and plan. A wealth of information is provided for each loan, including the date of the loan, the amount of the loan disbursed, the outstanding principal, the outstanding interest due in the current month or in arrears, the annual interest rate of the loan, the payoff term, the status of the loan, for example, is it in a grace period, deferment, is it currently making payments, in default, and the loan servicer. Once you organize this data, you can assess the situation and apply strategies that will be discussed in Part 2 of this content lecture. If the client has private bank loans for funding that education, then you'll need to gather that information from other sources. Let's take a moment to understand the federal student loan default process. A loan becomes delinquent after you miss a payment. That delinquency gets reported to the credit bureaus after 90 days. Official default occurs after 270 days of no payment. There are several negative impacts of being in default. These include interest continues to accrue on the debt, consolidation and debt repayment options may not be available to you, new federal loans are not available, wage may be garnished, personal credit scores will drop lower, and job searches may be negatively impacted. There are several actions that one can take from falling into default. They include organizing your loan portfolio data, consolidating loans so that you only have to make one monthly payment, use forbearance strategically, select a different repayment plan, which creates more affordable monthly payments, and contact the loan servicer to discuss options before official default occurs. After default, you'll need to contact the Department of Education to establish a repayment plan. In this lesson, you learned about Federal Student Aid website, personal loan data available through the National Student Loan Data System, the default process for federal student loans and actions that help to prevent falling into default, and the implications of student loan default.